Good morning and welcome to our financial results presentation for the 2023 financial year. By now you would have become used to our format, a bit like our strategy, doesn't often change. We stick to our plans. So as usual, I'll do a bit of an overview. Then Anton will give you as much disclosure as we possibly can to ensure that you can make informed decisions from the information that we are providing. I will then just give you a little bit of a view of what we currently are busy with. And then, of course, right at the end, we will take some questions. Shoprite is a very big business. It's large. It has over 3,000 stores, 150,000 people, but yet it's the small things that's important. So today we've elected that I'm talking to you from the 10 Rand truck. That's the truck that we, together with our soup trucks, send out when disaster strikes. When Anton gives his part of the presentation, you will see this backdrop, our homegrown range. That is a range specifically designed to help our small suppliers. And one of our success stories in there is our Kailicha cookies. I'm extremely proud of the daily dedication of our team across the entire business. And a real sincere thank you to each and every one of you. It's the team Shoprite that makes the difference. Our people have learned to embrace resilience. Resilience meaning fix, do something, agility, adapt to the situation, like the solar or COVID, whatever comes our way, and then staying relevant. The launch of Prime, still trying to be innovative, our partnership with our world champion, Brad Bittner. It's our people that makes the difference. And one can look through these pictures and you can see from the looting right through to maybe the fun side, that it's only because of the people from Shoprite that has an attitude of it can be done. That is what makes the difference for this organization. We have now surpassed the 200 billion sales milestone, and by quite some margin. It hasn't come just by accident. It came by plan, by continuous investment over the long term. And unfortunately, the negative part of this is that the 1.3 billion that's now very topical that we had to spend on the diesel to keep our stores open and to make sure our customers get product and still getting good prices, is that is actually the money that should have gone as a profit increase for our shareholders. The 200 billion in revenue I just referenced, so the actual number was 215 billion for the year. But what makes this exceptional is that the additional revenue that equates to, that we had to add during the year, is 31 billion. And in 31 billion is probably as large as some organizations in total. The gross profit is also an enormously large amount of 51 billion. And you will remember that in the first 6 months of the year, we dropped below 24% in our gross profit percentage margin. And in the last 6 months have managed to creep a little bit back so that we could end at 24.1% for the year. It is so that globally all of our retailers has to absorb some of the inflation. The pressure on cost increases from manufacturers and all of the cost factors, especially that we are experiencing in South Africa, has resulted in that we have to protect our customers to some degree. And we've done that. Very pleasing for me is that we are still able to increase the dividend for the year by 10.5%, illustrative of the ability of the organization to positively generate cash. Very telling is that we are still gaining in customers. Our customer visits up by 13.2%. But as I've always have explained is that the very telling number is the volume growth. The positive volume growth that we've been able to achieve of 4.9%, which equates to more than 335 million additional items being sold during the past year. Even excluding the Masscase stores, this number is still a positive 3.8% in volume growth. This resulted in an 8.1 billion rand gain in market share. It's the fifth year in a row, financial year in a row, that the group have gained market share, and also now 52 months of uninterrupted market share gains. About 6-7 years ago, we very clearly have separated our consumer brands between the Checkers, Shoprite user brands with a very clear position. And that balanced portfolio has really proven in good stead for us. If we look at the Checkers brand, 70 billion in revenue, growing a staggering 18% last year, by far the highest growth retailer in the premium segment of the market, with a market share currently sitting at 14.8%. And on that point, I'd just like to mention that we do believe there's still a lot of headroom, given that we only at basically 15% market share. And then very telling in this whole scenario over the last couple of years is the 10.6 million extra savings customers that we have. The data points actually that we have on them. And what makes it really powerful is the fact that the data is so relevant because of the frequency of interaction that customers have with our brand. Primarily because it's food related, but the data is very current and that drives our decision making. And if you look at the wheel on the right hand side, you can see that our customer value proposition is very clearly defined. I'm not going to go in each of the detail, but you can understand that we do fit them in each of the blocks that they belong when we execute. Then the Shoprite brand, that still equates to 60% of the South African supermarket revenue at 90 billion. So that is the big one. Growing at, in my view, a very solid 15.6% in the last year, which equates to just under 20% in market share. Here, even more so, the criticalness of having 17.2 million extra savings members, which includes previously excluded data points for cash customers. And again, I just want to reiterate that the Shoprite Group story is not a Checker story only. We do as much innovation, there is as much creativity going into the Shoprite brand. And if you look at that wheel again, very clear in our customer proposition, it's just different. That's why we have 5 Rand meals, and that's why we can surprise and delight people with, here behind me, 1 Rand biscuit, a sweet treat. You almost can't imagine you can still buy something for 1 Rand. The year that was really a telling story of an industry-leading growth for supermarkets South Africa. I'll get to the inflation graph now, but first I just want to mention that supermarkets South Africa growing at 17.8% on a very high base already is a very, very strong result. And without any economic tailwinds, it almost feels like we have to create our own oxygen to mobilize such a growth across the entire business. And hence again, I want to repeat that it's not only a single brand story, it's a momentum across the entire business. Even excluding the sales from the MassMart Acquisition, still a combined growth of 16.2%. Liquor stores had an outstanding result this year, outgrowing the market by 1.3 times. 60/60 stays a good story, growing 81% on top of 150% last year. then I think it's important that the position what the Shoprite Group has always maintained is our value offer to consumers, that we consistently, throughout the 12 months of the financial year, have been below the official food inflation. That is, meaning our own internal inflation have been below the official food inflation. Customers are really stretching their budgets. So very clearly over the last 2 years, we've seen the participation of promotional items in the basket increasing by more than 5%. Clearly, customers are looking for value. Also so that customers are starting to combine their purchases, and that's why we also have these combination purchases or deals to assist customers to get even better value. And I always say, don't underestimate the customer. They are very creative to make their budgets work. And because of our data and our ability, we use that to deliver the consumers what they expect from us. As an example, 50% of tuna that we now sell is from our Right brand private label. Unfortunately, I have to show you this graph. We're not well known for making excuses. We deal with what comes our way, but 88% of the last financial year, we had rolling blackouts. That now has resulted in that well-publicized 1.3 billion in diesel costs that we had to incur. But I want to emphasize here that it's not us only as the retailer, but it's the entire value chain that gets affected by this. So really from farm to fork, it's additional security costs, it's the food waste. You can imagine if any production line is interrupted midway, all of that food production has to be wasted. So it's something really, really critical for the entire country that we get this thing sorted so that we can get our economy back on track again. And then what's our promise? What is it that Shoprite does? When I talk Shoprite, of course, I include all of the consumer brands, is our unconditional savings for consumers. We don't do double points and special conditions and funny names. We give instant cash at the checkout. And that this year amounted to a staggering 13.5 billion. And I believe in anyone's language, that's an incredible large amount of discounts. And we're very proud. And we're not shying away from this. The fact that consumers are actually demanding and asking for more promotions on the earlier slide, we're embracing that to entrench our position as the leading value provider for consumers in South Africa. I have mentioned earlier the 10 Rand items. So we sold over 130 million under 10 Rand products in the last year. And then we have this affordability obsession. We've never shied away from that. So just as an example, since 2016, we have now sold over 600 million 5 Rand meals and loaves of bread for 7 years now with a zero inflation. I think quite commendable and appreciated by our consumers. When I spoke about the market share earlier, I thought this picture actually illustrates exactly what I'm trying to say. So firstly, if we look at the 8.1 billion in the black, you can see it has come from both of the consumer brands, Shoprite and Checkers. So it's not a one-pony story. But I think the graph on the right-hand side clearly shows the multi-year investment, our ability to now start utilizing the tools in which we invested in terms of pricing, whether it's personalization, etc., to really meet the needs of the consumers, get our pricing right, and customers are voting with their wallets. And we can clearly see that gap increasing over time. The rest of the operating segment that we don't talk about that often, including the rest of Africa operations, where we still trade out of 9 countries. We still managed to, in the last year, restrict the capital allocation to that segment and managed to achieve our medium-term guidance that we've gave you before. just missing 600 million in profit contribution. Very happy that we are still limiting the capital allocation to that, but still achieve a decent number, yeah. On furniture slightly flat, pretty much in line with what's happening in the industry. What development we have been improving on here is our ability to advance credit, improve the process, easier to apply, quicker turnaround time, and we've seen an uptick in the credit participation. Although cautiously so, we understand where the credit advancement in South Africa currently is and how in debt the consumer is. On the other operating segments, I mean, OK franchise as a division is really becoming meaningful, 535 stores, and also innovation and development on that side of the business. A request from our members have assisted us in creating another brand that we're trialing in terms of the franchise, and we see constantly an increase in the direct purchases from the group by the franchisees because of the partnership that we are forming with them. Transform and Medirite have performed fairly well, double digit. We also there are trialing some more innovation and different formats. So, as I mentioned earlier, all parts of the business currently has some form of creativity or innovation. Now, of course, this is what you've all been waiting for. The detail that Anton is going to give you around the disclosure so that you can, as best as you can, perfect your operating models. So I'm going to hand you over to our very fine CFO, Anton de Bruyn.
Thank you, Peter, for that introduction and sharing some of the insights into the operational performance of the business for the year. The group delivered a strong financial result, which I will share as part of my part of the presentation. For ease of reference, we've included additional information in the appendix that deals with the adjusted diluted HEPS calculation, as well as how we look at our weighted average cost of capital, as well as our return on invested capital. Also included is a detailed analysis of items of a capital nature. My part of the presentation will deal with continued operations. During the financial year, we exited our operations in the DRC, which we now deal with as discontinued operations, and hence also our restatement of the 2022 financial year results. During the first half of the year, we concluded on the MassMart transaction. The effective date of the transaction was the 9th of January, so as part of the second half results for the year. This number of stores acquired was at 94 stores plus one meat plant in the Gauteng region. If I look at the consistent of with the stores that form part of the transaction, we converted 51 stores to Shoprite, one store to Usave, and then 42 stores to Shoprite Liquor. Two of the liquor stores did not trade at the end of June as a result of the fact that we couldn't get the liquor licenses in time transferred. One of those liquor licenses has now been transferred, and we also expect the second one to be transferred in the first half of the 2024 financial year. The purchase consideration that was at fair value was 662 million. If you looked at what it makes up of is property, plant and equipment of 322 million, inventories of 367 million, and then also various employee benefits of 27 million. The 94 leases plus the meat plant made up of the right of use asset of 784 million, as well as the lease liability of 784. The number of employees transferred as part of the transaction was 4,480, and the sales for the first half for the retail was very much in line with what we estimated, and that was at 2.4 billion rands of sales. If we then turn to the financial highlights, Peter spoke about the increase in sales. Total income increased by 15.6%. On a normalized basis, our total income increased by 15.2%, and I will discuss later the items that impacted that. Total expenses increased by 18.6%, and again, excluding some of the abnormal items during the year, our normalized growth would have been 14.9%. What is very pleasing for management is that our total income growth still exceeds that of our expense growth. Trading profit was 11.9 billion rand at a trading margin of 5.5%, representing an increase of 5.7%, and a very strong EBITDA of 18.8 billion rand, an increase of 13% year on year. We did realize an exchange rate gain in the current year versus the loss of 259 million in the previous year. And the gain was as a result of our hedging strategies within the Angolan environment. During the year, the Angolan kwanza devalued by 68.7% against the rand and more than 93% against the US dollar. Now, as you know, we have those, we've invested in those US dollar linked bonds, and as a result of the currency devaluation, it materialized a profit or a gain in the financial year, which was the majority of that gain. Earnings per share, very strong 10% increase, with diluted headline earnings per share up 9.7%, and then also our adjusted diluted headline earnings per share up 3.8%. And as I mentioned, there's a detailed analysis of that in the appendix. Our return on invested capital, excluding IFRS 16, was 14.9% versus the prior year 16.9%, and that was really driven as a result of the additional diesel usage during the year. Our weighted average cost of capital is 13.5%, lower than our 15.1% in the prior year, and that was as a result of how we look at our beta measurement. Our dividend per share increased by 10.5% to a full year dividend of 663 cents. Our final dividend was 415 cents, which was a 13% increase year on year. Our return on equity for the year was 24.8%. If we then turn to sales, Peter has spoken a lot about what we've achieved within Shoprite and Usafe, as well as in Checkers and Checkers Hyper. Maybe just a shout out in terms of our supermarkets RSA business. We saw acceleration of growth during the second half of the year. First half, we achieved a 17.5% sales growth. Second half accelerated 18.2%. That gave rise to that 17.8% growth in our supermarkets RSA. Maybe just on Liquor Shop, we saw that 30.8% sales growth, driven by 112 stores opened during the financial year, which did include that 40 stores that we saw from the MassMart Acquisition, but also pleasingly is the 61 new stores planned for the 2024 financial year. The other business units within that supermarkets RSA business or segment contributed 400 million, and on my next slide, I will give some context of the new store formats that we've rolled out. Supermarkets non-RSA increased by 16.4% on a like-for-like basis of 16.3%, and internal food inflation we measure around 6.1%. We've spoken a lot about affordability and also currency stability that will drive the growth within that segment. But again, unfortunately, we saw major moves in currency and volatility in both our Zambia, Ghana, and Angola business units. Furniture increased by 5.1% to 7 billion. Majority of that growth is in our non-RSA segment of our furniture business in the rest of Africa, with muted growth in the South African context, but we've seen an overall muted growth within that sector. We've managed to increase our credit participation to 14.9% and increase it by 1.5%. Other operating segments increased by 13.3% on the back of a franchise increase of around 13.5%, now trading from 535 stores. And then we also saw our MediRite and Transform business increasing sales by 12.2%. We always get a question around the store footprint of the group and the different formats. We've put this slide together to give an indication of the growth that we've seen within the RSA supermarkets environment. We've added 301 stores during the period. Again, a lot of growth coming from our core Shoprite and Usafe business, where we opened 68 new stores with the 51 acquisition from MassMart. Checkers also opened 23 stores, and pleasingly for us is the opening of those 4 Checkers food stores, where we see quite a lot of traction again within the suburban areas. Liquor Shop, very strong, 73 stores, opening more than 1 store a week. and the 40 stores from the MassMart transaction. And then the pet shop business, where we opened 31 stores during the year, already trading from 53 stores. And I know Peter is chasing the team extremely hard to reach that first 100 stores within that brand. From our other business point of view, we've opened those 9 unique clothing stores. We now have 8 outdoor stores and also 9 Little Me stores, totaling 31 additional stores. In total, trading from a supermarket's RSA point of view, we have 2,121 stores. If we then turn to the income statement, from a total income point of view, we saw an increase of 15.6% to 56.5 billion rand. Excluding the impact of the loss of profits claim that we received in terms of the civil unrest, the 222 million, our normalized total income increased by 15.2% to 56.3 billion rand. Our gross profit increased by 14.8% to 51.7 billion rand, an increase of 6.7 billion rand in the current year. We did, however, see a decrease in gross margin for the full year from 24.5% to 24.1% on the back of our price investment strategies, as well as an increase as a result of diesel in our supply chain, where we saw a 25.7% increase in the diesel price. If I then look at other operating income and the ways on how we look to unlock alternative revenue streams within our ecosystem, we saw an increase of 25.4% to 3.9 billion rand. Some of the major items contributing to that 3.9 billion was commissions received within our money markets, where we saw a 15.6% increase to 1.1 billion. That was on the back of new products launched within our money markets, as well as the increase in payouts for the government grants. We saw a close to 50% increase in delivery recoveries, driven by our more than 80% increase in our 60/60 on-demand business unit. And then from our Rainmaker Media and Inside Data Monetization products, we saw a more than 100% increase to 383 million rand. I've spoken about the loss of profit claim. And then from our property portfolio, we saw a 7.1% operating lease income to 468 million. Interest revenue increased by 22.2% to 665 million. If I look at the items that contributed to that interest income, firstly was the growth that we spoke about in terms of what we've seen within the furniture book and the interest received on those on the debtors. And then pleasingly also, we spoke about our CredEx business last year. We now on average have around 500 million rand of credit granted to our SMEs and suppliers. That also gave rise to the increase. And then lastly is around 153 million rand of that interest equates to the investment of around 1.3 billion rand in our government bonds, as well as treasury bills in Angola during the year. Our share of profit of equity and account investments increased by 20.7% to 251 million. 208 million of that is from the Retail Logistics Fund that currently houses our distribution centers and that partnership with Equitas. And then 43 million rand was derived through our Pingo business unit, where we have a partnership with RTT on the last mile delivery for our 60/60 business. From a normalized point of view, total income margin that we see is continuing is 26.2%. If I then turn to expenses, we saw an 18.6% increase to 44.6 billion rand at an expense margin of 20.8%. Some of the major items contributing to the expenses are depreciation and amortization, where we saw an increase of 17.1% to 6.3 billion. The ratio of depreciation to revenue is still at the 3% target that we set ourselves. Some of the major drivers was 18.5% increase on our depreciation on property, plant and equipment, as well as a result of that strong store opening program, as well as the depreciation on some of the IT projects that we've delivered that forms part of our intangible assets. We also saw a 15.2% increase in our right of use asset depreciation on the back of those additional leases pertaining to the store opening program. Employee benefits increased by 15.3% to 17 billion. During the second half of last year, the group launched our Shoprite Employee Trust Scheme. We expensed 235 million in the current year versus the 128 million in the prior year. That led to an additional 107 million. If we exclude that 107 million, our growth was 14.6%. And then another anomaly that formed part of employee benefits during the current year was the 193 million included in the 2022 result as a result of that civil unrest that was a once-off. If we therefore have to exclude those two anomalies, our core growth within our employee benefits would have equated to around 13.1%. That growth was driven by the 8,131 new job opportunities created. 285 million rand of that growth relates to the MassMart transaction, where we added those 4,480 new staff members. We also contributed 91 million rand to the government's in support of government's youth employment scheme, where we have currently more than 2,000 participants in that program. Electricity and water increased by 36.6% to 4.9 billion. Peter has spoken and has shown the graph on the additional diesel spend of that 1.3 billion. In the prior year, we did spend 200 million, and that's why we refer to that 1.1 billion as additional spend in the current year. Excluding the impact of that additional diesel spend, we expected our electricity and water to increase by 6.1%. Other operating expenses increased by 18% to 16.3 billion. Some of the main drivers was firstly that increase in our insurance costs, where we had to source additional insurance, giving rise to the civil unrest. We could not cover ourselves through Sasria or get fully covered through our Sasria offering in the current year, hence the fact that we had to source additional insurance for that. And that came at a massive cost of 181 million rand. We also saw a 15.2% increase within the advertising spend to around 3.7 billion rand for the year, which was largely as a result of the strong sales growth that we achieved within the financial year. Our security costs increased by 12.5%. Firstly, obviously, how we look at protecting our assets and in terms of loss prevention. But if we look at our historical rates, we've kept on spending around 1% of revenue, and this year was no different to that. Lastly, we saw a 18.6% increase in maintenance costs to around 2.5 billion rand, and that was also on the back of the load shedding that we experienced. If we therefore exclude some of these anomalies or abnormalities, our expense margin would have been 20.1%. We then turn to trading profit. Supermarkets RSA, we saw an increase of 5.6% to 10.8 billion rand. Still a very strong trading margin of 6.2%, lower than the 7% of the prior year, but as we said now on a few occasions, driven mainly by that diesel expenditure. Supermarkets non-RSA, very strong performance with a growth of 24% to 594 million. Slightly ahead of the guidance that we've given in terms of our short to medium term growth of 500 million rand. But we have seen, and we've gained also, some of these gains were as a result of exchange rate movements. Our furniture business, we saw a decline of 50.7% to 104 million rand. There were two reasons for that. First, our investment in gross margin to stimulate sales within the South African context. And then we also had to increase our debtor provision on the back of the additional and increased credit participation that we've seen within the segment. Other operating segments increased by 17.6% to 427 million, supported by the growth in our franchise business, where we saw a 5.6% growth in profitability, our MediRite and Transform business contributing very well, and then also our CompuTicket business, where we've seen an increase in traveling and entertainment again. Our trading margin for the year was 5.5%. And just for comparability, if we had to exclude the additional diesel expenditure, we would have achieved again that 6.1% trading margin that we've seen in the past years that we achieved. Our net finance cost increased by 18% to 3.2 billion rand. on the back of a 350 basis point increase in interest rates during the year. What was very pleasing is that the increase in our interest received was in line with what we could also see in our borrowings, and that was at 67% increase. Our borrowings during the year did increase by 856 million, and our average cost of funding in terms of our borrowings is 7.9%. If we then look at lease liabilities and the finance charges related to that, we saw an increase of 16.3% to 3 billion. That's on the back of the increase of around 15.2% in our lease liabilities, and our average cost of funding related to our lease liabilities is around 8.9%. If we then turn to the balance sheet, mention the increase in our borrowings to 6.4 billion rand. Our borrowings to equity ratio is at 24.2%. Historically, we gave that target range of 25% to 30%, but I think in the current interest rate environment, now is not the time to increase our borrowings, and that's why we also spend quite a amount of time looking at our capital allocation model, as well as the capital that we invest back into the business. US dollar borrowings decreased from $43 million to $29 million, and it's now at around 8.5% of our total borrowings. We saw a 3.1 billion rand increase in our right of use asset and a 4 billion rand increase in our lease liability on the back of the aggressive store opening program, and then a positive move within our net working capital. I will unpack inventory in the next slide. We saw a positive move of 10.5% in our net cash, and we ended the year on 6.6 billion rand. But one has to take into account when looking at our net cash is that we did settle 630 million rand relating to the MassMart transaction already as part of the financial year. And then, as I mentioned, if we look at the CredX business, where we on average lend around 500 million, we would have actually achieved a much better performance within our net cash for the year. Looking at our capital expenditure, our capital spend as a percentage of sales was 3.1%. Excluding the impact of initial capital we spent relating to the MassMart stores, as well as the replacement capital that we spent in terms of the social unrest, our targeted 3% was achieved. That equates to around 6.7 billion rand in capital, or 25.5% increase. How we always look at our capital expenditure is how much do we actually allocate to expanding the business versus maintaining the business. And again, this year was no exception, where we spent 3.8 billion rand on expanding the business purely through sales growth, and then also our digital acceleration, where we spent 458 million rand. It's critical for us to also maintain our stores and to remain relevant, and there we spend an additional 1.85 billion rand, and on our IT infrastructure as well, additional 190 million rand. An additional measure that I decided to introduce or share with the market as well is that we must understand that not all capital that we spend in the current year, we will also realize the benefit during that year. So 71% of the capital that we spend in the current year, we also realize the benefits, and that will be through the opening of stores or the launching of new money market items or products. But what is important to note is that a third of the capex that we spend in the current year will only give us benefits and improve our shareholder returns in years to come. The Shoprite supply chain is a critical part of the success of our business. And with the aggressive store opening program that we've had over the last few years, and if I also look at the next year, it was important for us to invest additional capital in also expanding our distribution space. So that's why I'm giving you already some of the insights into what we will spend in the current year in terms of our distribution space, as well as the next financial year. So already now in October, we're taking live our additional space of around 38,000 square meters in Natal. That is funded through our retail logistics fund, where we have that partnership with Equitas. The capital that will be funded through Shoprite will be 200 million rand, and we estimate that the additional inventory that we will report on in the first half of the 2024 financial year will be an additional 300 million rand. We're also investing in our Centurion transport facility, an additional 7,000 or close to 8,000 square meters, where we will fund an additional 75 million rand. The capex to actually develop those sites will then obviously go through the Retail Logistics Fund. If we then look at 2025, through Equitas Property Fund, we will take on stream a close to 94,000 square meter distribution center in Gauteng. Shoprite again will fund close to 700 million, and we estimate that the inventory build will also be around 700 million. What is important to note is that although we will only start trading and moving stock from that DC in the 2025 financial year, we will already start GRVing and taking in stock, which will have an impact on our inventory levels for the full financial year. We're also taking live the Wells estate in the Eastern Cape, where we currently do not have property or distribution space of this size, where we will fund ourselves around 630 million rand. And we also estimate that we will see an inventory build of around 600 million. That development will also take part through the Retail Logistics Fund. So over the next 2 financial years, we look at adding around 1.6 billion rand in inventory, which I will also share on the next slide. If I then turn to inventory, we saw a 14.7% increase of our inventory to 25.1 billion rand. It's a move of around 3.2 billion. The majority of that stock was in the supermarkets RSA segment, where we saw an increase from 17.2 billion rand to 20.3 billion. As you can see, the other segments very much stayed in line with the prior year. We are very happy with the result around our inventory to sales ratio, where we actually saw improvement from the 2022 result to the 2023 year. Supermarkets RSA is the main driver, where we saw 11 points and a consistency around that 11.7%. We did see an improvement in supermarkets non-RSA, but that was really driven as a result of currency volatility. If we had to exclude the impact of our distribution centers and only look at the stock holding within our stores, we saw an improvement from 9.3% to 8.4%. And within the supermarkets RSA environment, we actually saw a 1% improvement from 9% to 8%. I think what is clear from what we could see is that the majority of our stock holding actually happens within our, or is held by our distribution centers. And the reason for that is twofold. The first is to be able to service the expanded footprint and store opening programs that we had during the 2023 financial year, as well as what we planned for the 2024 year. And then also as a result of deteriorating supplier service levels that we've seen in the last year or two, which obviously leads to the reason why we carry our additional safety stock levels. A very good example of that was also during the taxi strikes that we've now recently had within the Western Cape, where we were able to maintain our high in-stock levels, but where we could see that some of our competitors could not do the same. In fact, we saw that they had to close some of their distribution center operations. The free cash flow measure is extremely important for the group, and if we look at the free cash flow conversion rate, and what we mean by that is how we look at our free cash flow, that 11.5 billion rand, as a percentage of our EBITDA, the 18.8 billion, and that's a very strong 68.6%. And then as I also look at our operating cash conversion ratio, which is our operating cash flows as a percentage of EBITDA, is currently sitting at 99.1%. If I just look at some of the main items making up our free cash flow, EBITDA, I spoke about strong growth, was at 18.8 billion. Our effective tax rate has remained consistent. There's a 2.7 billion from that, and then refurbishments, additional 2.1 billion rand, giving us a free cash flow of 11.5 billion rand. And what we said is if we had to exclude the additional diesel, we actually would have generated 12.6 billion rand of free cash flow. How did we invest that capital or cash flow? Firstly, through plowing back into our business, through expanding the business of 4.6 billion, the acquisition of MassMart of the 630 million we paid, and then also the 3.4 billion paid to our shareholders. The net of all of that was a very strong 700 million rand cash movement, after also taking into account our net finance cost. In closing, then just some guidance around 2024. If I look at sales, MassMart only formed part of our second half results. And And if we include that now also in our first half, we expect to achieve around 2.5 billion rand of sales. From an operating cost and income point of view, we must remember that the insurance claim was a once-off 244 million in the prior year, which we received in the first half. That will not repeat in the current year. We do expect to still continue spending additional diesel throughout our 2024 financial year. And what is important to note is that we did see that additional expenditure only from September 2022, which means that we will most probably have additional 3 months of diesel expenditure in the 2024 financial year. As mentioned, our effective tax rate has remained quite stable during the last few years, of 30.6% in 2022 and 30.8% in the 2023 financial year. And there's no reason at this stage why I think we will not be again between that 30 to 31% range. Our capital allocation remains consistent in terms of our dividend policy, currently at 1.75 times our diluted HEPS. We did have a mandate in terms of share buyback from our board. As a result of the additional diesel expenditure and the MassMart acquisition, we did not do any buybacks in the 2023 financial year. And if I look at the additional capex that we will spend in the 2024 financial year and the additional exposure around diesel, I cannot see us doing any share buybacks also in the 2024 financial year. Talking about the capex, I've spoken about the investment in supply chain. We also plan to upgrade the 94 stores that we acquired from the MassMart business and during the 2024 financial year. And then we still plan to open an additional 314 stores during the financial year. All of that equates to around additional capex spend for the year of 8.5 billion rand. If I exclude the MassMart upgrade as well as the investment in supply chain, we get back to that 3% target range that we've set ourselves internally. Currency stability and affordability remains the driving force within the non-RSA segment, and it becomes very difficult to estimate the profitability of this segment. We do expect a lower interest earned from our investment in our government bonds purely on the back of a devaluing Angolan currency against the rand. And that's why we're not changing our medium-term trading profit guidance of around 500 to 600 million on that segment. The group plans to open 314 additional stores during the 2024 financial year, as well as 98 of our franchise stores. Inventory for the full year, we estimate to be around 12% of sales based on the inventory build in the new distribution centers, as well as maintaining our high in-stock levels for our customer availability. Thank you, Peter. That is then the full financial presentation, and over to you around the strategy of the group.
Thank you, Anton. I sincerely hope that those disclosures that he's just done will assist you in making better informed investment decisions. Just again, a reminder of what it is we stand for and why. The Shoprite purpose defined as uplifting lives every day. And that's across the entire spectrum. No exclusions. And of late, we are very conscious that we also need to protect the planet in all of this that we do. You've become familiar also with our 9 strategic priorities that guides our daily decision making. We're not known for making knee-jerk reactions. We have embarked on a strategy 6-7 years ago, and we are still pretty much exactly on that journey. Mainly in 3 buckets: the smarter Shoprite, the headroom that we have where we target additional opportunities, and then we want to win in the long run. And it's the combination of this that is delivering the results that we see today. So in the smarter Shoprite, very quickly, a truly customer-first focus, easily said, hard to execute, very hard. But every day, that is what we drive. We have our own adage And everybody in the company lives up to that. Creating future-fit channels, and the challenge these days is to recruit and retain the talent required to support those challenges. That's why it's become a very strategic driver for us. And precision retailing, I've been talking about for years, and I think I said last time also, people frowned upon that, and now it's being used often. We've invested heavily into enabling precision retail. I have mentioned earlier about the customer data. Let me just clarify, the customer data is around their buying behavior and the products that they do and their price sensitivity, and so not about their personal data. We're of course very protective of that. Then the opportunities that we see, we have to double down, and I have something later on also about the private labels, just purely because the sheer volume requirement that the group has on a daily basis, especially when we're on promotion, now necessitates us to double down actually on investment on our private labels. Fresh food, our growth in the premium fresh food market has accelerated. I'll share that number with you now. And partnerships is very important to us. At the speed that it is required to grow and keep on growing in today's world, we can't do everything ourselves. We will just be too slow. So we are cherishing our partnerships in store as well as externally. And then when in the long run, you will notice the other income line on the income statement is now just hitting 4 billion, growing at 25%. And we have mentioned to you 3-4 years ago that in time to come, it will become more and more meaningful, although still today it's not really moving the dial in totality, but it is contributing and more so. Force for good, I mentioned. For us, it's not a tick anymore. I'll cover 2 or 3 points just on that to illustrate what we do. But it has now come onto the forefront of one of our strategic drivers. And then, of course, we leverage our platform. It's in our flywheel. It would be my last slide. You're very familiar with that, is that everything hangs from our core retail business. So yes, it's been a busy year. It's been very busy. But it's not true that we are so busy that we are getting distracted of what it is that we need to deliver on. I'm not going to read all of them. I'd like to point out the Rex platform. Fantastic for us is that we don't have to guess anymore. When we sit with our suppliers, manufacturers, partners, we don't have to guess about what is right and which data is correct. We're all working from the same source, and it's a very current and relevant, and it really speeds up our decision making and making sure that we all align in terms of what we want to deliver. I can point out the 60/60 service guarantee. Yes, we are doing well, but that doesn't mean we stop innovating and improving. So we are putting our money where our mouth is. Have to call this out. In this environment, to have created over 8,000 new jobs, very pleasing result, very happy about that we can make a difference in so many lives. And the personal pride of mine is the fact that our employee trust have been able to distribute over 230 million to our employees as part of their reward of delivering fantastic results. We also created CredX, that in particular is where we advance credit to our suppliers for bridging finance. Also part of the small supplier development program. And overall, we have managed to open 382 stores for the year. Not entirely what we wanted. We wanted 425, but these days there are obstacles like electricity connections and sewage and water that is hampering the speed at which we do this. But for the new year, we're still planning to open 314 stores. The money market bank account required quite a bit of investment. It's complicated, it was expensive, but it's finally bedded down, and We're seeing very good traction on that. Basically, the only transaction-free bank account in the country, apart from when you withdraw money. That's the only time that there's a charge. And towards the end of June, we have delivered or soft launch on our subscription model on the 60/60. As you know, even when the business does well, it also requires even more investment because we believe it can do even better. The smarter Shoprite, this is just very quickly, in a nutshell, is maybe a repeat of a lot of things that I've already said. But if you just look at the sheer size of all of the transactions and the involvement, we have 415 million financial transactions, over 3,000 stores. 60/60 now operates from over 400 stores. And possibly for me, the most critical of why I'm showing you this is that 27.8 million extra savings members. And the pure fact that their usage rate is by quite a margin bigger or more than what the international standard is quite telling. And you can see there almost 2,500 swipes a minute. And that keeps the data current in terms of how people buy and what substitution they do and what categories they are leaving. And we share all of that data with our suppliers, and that just helps us all to make quicker and better decisions. 60/60, our online 1-hour grocery delivery business, I mean, a success story by itself. I did mention 80% growth on top of 150% last year. That graph has just continued to grow. Most people thought that somewhere we're going to fall off a cliff, but it's absolutely not what is happening. And again, a fantastic story to say that over 9,000 new job opportunities being created since the launch of this service. As I said, we don't stop. We keep on innovating, and basically it was a soft launch. This is a subscription model, 99 Rand unlimited deliveries. The official launch is next week, and we have decided it's in a week's time that we will give you a preview of what our launch commercial would look like.
Hello, South Africa. Checkers has done the impossible.
Unlimited 60/60 deliveries are here with the new Extra Savings Plus monthly subscription. Get whatever you want, whenever you want, as often as you want it. For just 99 Rand per month, you get unlimited 60/60 deliveries for free. Plus an extra 10% off one in-store shop every month. Unlimited 60/60 with all the pluses. It's possible. The world's most famous actor telling you about it. Well, who's signing up with me?
So you have become accustomed to a very creative Shoprite X and 60/60 team, and I hope you enjoyed that, and so with the consumers. We do believe it's a compelling offer that will just, again, put us ahead of what's currently in the market. The private labels I've mentioned, and in previous presentations, I have explained that we have a slightly different view on private labels than what I believe most of our competitors have, is that we always try to fill a specific need state and not just more of the same. But there's one thing about our private labels that stands out is the loyalty factor that it also creates. So you can see there 96% of all our consumers actually buys at least one of our private labels. Just as an illustration of that. The contribution, slowly, we've been tracking that slowly up. 6 years ago, we were at 13%. We're now at, let's call it 21%. But we don't make a specific set target for that. We will address it as the need state arise and as our data is telling us where the gaps in the market exists. What has been very successful is the premiumization of our private labels. In that, examples would be what you probably familiar with is Simply Truth and Forest and Feast. And what is quite telling of this is that there was a clear gap in the market from local manufacturers and even multinationals, that we had 7 premium labels in the Checkers brand that achieved almost 30% in sales growth in the last year. Liquor, I have also pointed out, growing at 1.3 times the market. We've opened our 700th store, and we're not stopping. We certainly are continuing to grow that business. That team averages about one new store a week, and we hope that they can maintain that momentum. And then here's what I mentioned about the market share gains in the fresh food part of the business. So out of the 8.1 billion in market share gains in the last year, 2.3 billion came out of fresh foods. And we're going to continue to push in this section of the market. We've got 87 fresh egg stores now. They're expensive, I know, but they also give good returns. And there, just a little picture. Every store of ours have a champion that ensures that the cold chain is not compromised. It's something we take very, very seriously. And then, as you know, we like to try new things. The pet shop is a good example here. Our standalone pet shops, the result of that is that the pet customer that we used to have, with now the introduction of the standalone store, are now spending 3 times what they used to spend in that category. Partnerships, I also referenced that. We cherish these. Our OK franchise partners, we like to refer to them as partners. We work together in terms of creativity and design and new concepts and systems, and that partnership is really becoming meaningful, and we are very pleased with it and their performance. And then also in-store, we have created these partnerships with Krispy Kreme, Starbucks, Kauai, those that you are familiar with. And in here also that plays a role is Next Capital, where we actively pursue supplier development, expanding capacity as we require more and more volume. We keep on investing through the cycle. The fact that there's currently no economic growth in South Africa doesn't mean we can stop investing. Because if you stop investing, to start again in the future is a slow start. So we keep on investing. Our supply chain, we've mentioned before, we're adding 200,000 square meters to the supply chain. And believe me or not, but in one of the regions, we are already out of capacity just because of the exceptional growth that region has achieved in the last 2 years or so. So we are planning again. Next round also. And then, we are leveraging on our proximity advantage. What we mean by that is having this very wide network of stores allows us to also experiment with some other concepts, like you've seen, the Little Me, Outdoor, Medirite Plus, etc. We have been doubling down on our digital investment to maximize our share of wallet. Having that 27 million extra savings customers, we just so much better understand what else it is that we can offer them to either save them money, save them time, increase their quality of life. I did mention Force of Good. Force of Good is not just a tick in the Shoprite group. We do an enormous amount for our communities. I like to say that big business can make big differences. And this is exactly what we do. There are big numbers on there. I'm not going to read all of them, but we are supporting not only on food, but also in community development, our early childhood development centers, the food that we donate, and not to forget or underestimate the large amounts of recycling that we do. We also do compost, and so we really feel that Shoprite is a responsible citizen, corporate citizen, in doing our part when it gets to the planet. We'd like to leave the planet a better place than what we found it. I know you're very familiar with this flywheel of ours, where at the center of everything we do is our core supermarket business. And then we build around this all these adjacencies in order for us to deliver on what our customers really expect from us in terms of saving them money, improving their lives, and giving them the things that they want, not what we want. Thanks for listening. Appreciate that.